Welcome to the Opening Bell Report.
462%.
It is a number that just stops you in your tracks, isn't it?
It demands a forensic audit. I mean, I was staring at the prep sheet for this deep dive for a solid 10 minutes, just looking at that figure, 462% revenue growth. When you see a jump like that in a single fiscal year, my brain immediately goes to one of two places. Either it's a typo or we're talking about some, obscure crypto mining penny stock that got lucky.
A meme rally or something.
Yeah, exactly. You just don't see those kinds of multipliers on serious billion-dollar infrastructure companies.
It certainly sounds like a statistical anomaly or maybe a base effect where they made, $10 one year and $50 the next.
Right.
But in this case, the number is real and the scale is significant. It's the headline figure for fiscal year 2024 for Nebius Group, ticker symbol NBIS. They went from roughly $20 million in revenue to over $117 million.
In a single calendar year.
A single year.
Which is a breakout by any definition. But we need to contextualize this immediately because we're recording this on Friday, January 30th, 2026. The world moves fast, especially in tech. So was that 2024 jump just a one-hit wonder?
Far from it. That 462% was essentially the proof of concept. It was the ignition moment.
Okay.
If you look at the data we have for late 2025, the trailing 12-month revenue is already sitting at around $366 million. So the engine isn't just running, it's accelerating. They've proven they can scale.
Okay, so we have a rocket ship on our hands. Nebius Group is currently trading around $85 a share, and it's been consolidating there after what I can only assume was a pretty wild ride for shareholders.
Wild ride is putting it mildly.
So our mission today is to tear apart the bull case analysis report for January 2026. We need to figure out how a company grows this fast, what they're actually selling, because, spoiler alert, it's not software.
Not in the traditional sense, no.
And why Wall Street analysts are slapping strong buy ratings on it with price targets that are frankly aggressively higher than where it sits today.
Right. And to understand Nebius, you can't just look at a spreadsheet. You have to understand this specific weird moment we're in with artificial intelligence. We're in what the analysts are calling the land grab.
The land grab.
But before we get into the weeds of GPUs and data centers, there's one comparison in this report that I think does about 90% of the heavy lifting.
You're talking about the public core weave analogy.
That's the one.
Okay, so for the listener who isn't glued to venture capital newsletters every morning, CoreWeave is the cool kid in the class, right? They're the private cloud provider that went all in on NVIDIA chips early.
Correct. CoreWeave is the private market darling. They realized early on that AI needed a different kind of cloud than what, say, Amazon or Google were offering. They're valued at over $20 billion.
Oh, they can't buy them.
But you can't buy it. And that's the problem for the average investor. You cannot buy stock in CoreWeave unless you're an accredited investor with a very deep Rolodex.
It's a closed club. I can't just open my brokerage app and buy a slice.
Exactly. And this is where Nebius steps in. They're positioning themselves as the key to that lock. The public CoreWeave, a pure-play AI cloud infrastructure company that you can actually buy on the NASDAQ.
And the kicker.
The kicker is that unlike most startups trying to chase CoreWeave, Nebius isn't scraping for pennies. They are sitting on a war chest.
A $2.5 billion cash pile, which, just to pause on that, is an insane amount of liquidity for a company this size. Most startups are drowning in debt. These guys are sitting on a mountain of cash.
It completely changes the risk profile, but, and this is where the story gets complicated and why the stock is arguably cheap, we have to talk about where that money came from.
Right, because Nebius didn't just spawn out of a garage in Silicon Valley last Tuesday.
No, and this is the elephant in the room. We have to address the origin story section of the analysis report. Nebius was born from the divestment of Yandex,
Which was widely known as the Russian Google.
For better or worse, yeah.
And I feel like for a lot of institutional investors, that name is radioactive. There's immediate skepticism. They hear Yandex and they think, is this a Russian company? Are there sanctions risks? How did we get from Russian search engine to European AI cloud?
It was a massive, incredibly complex corporate restructuring that culminated in 2024. Essentially, they took a machete to the company.
Right.
The Russian assets, the search engine, the ride-hailing, e-commerce, that all stayed in Russia. But the good stuff was spun out.
Define good stuff, because usually spin-offs are where companies dump their bad assets.
In this case, it was the opposite. They took the core technologies, the cloud architecture, and most importantly, about 1,300 senior engineers. They moved the headquarters to Amsterdam. Their servers are in Finland, France, and now the US.
So they took the brain trust and the bank account, left the legacy business behind, and just rebranded.
That's the short version, yes. The report emphasizes this distinction heavily. This is not a Russian company anymore, but here's the competitive advantage that people miss when they get hung up on the politics.
What's that?
They didn't start from scratch.
They hit the ground running.
Think about how hard it is to build a cloud platform. You need code to manage thousands of servers, to balance loads, to handle storage. Nebius didn't have to write that code from day one. They brought the proprietary stack and the people who wrote it from Yandex.
So while other startups are figuring out how to make a server blink, Nebius is deploying a stack that's already handled petabytes of data for a search engine.
Exactly. They started the race on the third lap. This is what we call hyperscale DNA. You can't just hire that off the street.
Okay, so they have the talent and the tech stack. But validation is a different beast. Just because you say you're a player in AI doesn't mean the market believes you.
That's the hurdle, and that's why the fundraising round in late 2024 was such a pivotal moment. They raised $700 million. But the dollar amount matters less than the names on the check.
We're talking about heavy hitters, Excel, and NVIDIA.
NVIDIA directly. Now, pause and think about that. NVIDIA is the kingmaker right now. They don't just throw money around for fun. When NVIDIA invests in a cloud infrastructure company, it's effectively a technical endorsement.
It's like the health inspector giving you an A+ rating.
It's better. It's Jensen Huang's team saying, we've looked at your stack, we've looked at how you network our chips. It works. You aren't going to meld our H100s.
And in this market, that NVIDIA certified stamp is basically the difference between being taken seriously and being ignored.
Precisely. It proves their tech isn't vaporware, and that connects right back to that 462% growth statistic. That number was the market's way of agreeing with NVIDIA.
So let's talk about what they're actually selling. We keep saying AI cloud infrastructure, but I want to make that concrete for the listener because they aren't selling ChatGPT. They aren't building the models.
No, they're the utility company. The report describes the business model as pure play AI cloud. The best analogy is that they're the landlords of the AI revolution.
Landlords. I like that. But landlords usually just own the building. Do they own the equipment too?
They own everything. Think about it this way. Everyone wants to build AI models right now. To do that, you need massive computing power. You need the chips, specifically NVIDIA's H100s, H200s, and the new Blackwell chips.
And those cost a fortune.
Upwards of $30,000 to $40,000 a piece.
And you can't just buy one. You need thousands.
You need thousands, and here's the technical nuance. You need them wired together in a very specific way. You can't just plug them into a wall outlet. This is about clustering.
So they all have to talk to each other instantly.
Instantly. If the networking isn't perfect using things like InfiniBand, you are wasting millions of dollars in idle time. This is incredibly hard to build. If you're a startup, you do not want to deal with that headache.
You don't want to be a hardware engineer. You want to be a software engineer.
Right. So Nebius buys the chips by the thousands. They build the massive data center clusters in Finland or Kansas City. They handle the cooling, the power, the networking. Then they hand you the keys to the compute.
So instead of spending $50 million on servers I might screw up, I just rent capacity from Nebius.
You rent the compute. And right now, the demand for that compute is, to quote the report, insatiable.
This is the land grab phase you mentioned.
Yes. In most businesses, the hard part is finding customers. In AI infrastructure right now, the customers are lining up around the block. The hard part is supply.
Can you get the chips delivered? Can you plug them in fast enough?
And that explains the strategy for 2026. The report says the goal is basically repeat. Buy GPUs, plug them in, lease them out. It sounds simple, but operationally, it's incredibly difficult.
Which is why that 462% growth was so important. It showed they have the operational chops, the muscle memory from the Yandex days to actually do it.
Exactly. They aren't just hoarding chips. They're turning them into revenue instantly.
Which brings us to the money. Let's look at Section 3 of the report, the financial fortress and the cash burn debate. Because I can hear the skeptics screaming already.
This is the friction point, yes.
On one hand, the revenue growth is undeniable. Over 200% growth continuing. They're targeting an exit of 2026 with an annual recurring revenue of somewhere between $700 million and $1 billion.
Which puts them in the top tier of growth stories globally.
And the gross margins are healthy too, 30 to 40%. But, and here's the big but, if I look at the operating income line, it's red. Deep red.
Correct. They are technically losing money.
So the bare view is, look, they are burning hundreds of millions of dollars a year. This is the dot-com bubble all over again. It's unsustainable.
And this is a classic misunderstanding of the infrastructure business model, especially during an accumulation phase. This is where the aha moment comes in for the bull case.
Okay, break it down.
You have to distinguish between burning cash and capital expenditures, or CapEx.
To my bank account, money leaving is money leaving. What's the difference?
Okay, think of it like a trucking company. Burning cash would be spending money on lavish parties or expensive billboards. That money goes out the door and you get nothing permanent in return.
Right. Money down the drain.
That is not what Nebius is doing. They are spending their cash on trucks. In this case, the trucks are NVIDIA GPUs. They're taking that $2.5 billion and converting it into income-generating assets.
So they aren't setting the money on fire. They're converting liquidity into factories, essentially.
Exactly. They are swapping one asset form, cash, for another, hardware. In an AI arms race, hoarding cash is actually a losing strategy. By spending it aggressively, they're building the engine for that $1 billion in recurring revenue.
So the burn is actually investment. But what happens if the hype dies? Then they're just stuck with a warehouse full of depreciating computer parts.
That is a valid risk. However, the report highlights that they have a safety net that almost no other company has. That $2.5 billion in cash creates a fortress balance sheet.
Because they have zero debt.
Zero debt. Think about their competitors. Most of them have to take on massive loans at 8, 9, 10% interest to buy these chips. Nebius already has the money in the bank.
That's a huge competitive advantage. It's like playing Monopoly, but you start with 10 times more money than everyone else.
And that financial safety floor is why the analysis report suggests the stock is currently disconnected from reality. It creates a unique floor for the stock price.
Let's dig into that disconnect. Section 4, Valuation and the Market Disconnect. We established the public CoreWeave thesis. CoreWeave is valued at over $20 billion.
In the private market, where you usually get a discount.
Right. Nebius has a market cap of around $24 billion. But if you strip out the cash...
Yes, let's talk enterprise value. This trips people up. Market cap is the sticker price. Enterprise value is the price to buy the business minus the cash they have on hand.
So if I buy a wallet for $100, but there's $20 inside it, I really only paid $80 for the wallet.
Perfect analogy. When you look at Nebius through that lens, the enterprise value is closer to $21.5 billion. The argument here is that Nebius has similar targets to CoreWeave, superior liquidity, and a public listing, yet the market isn't giving them full credit.
Why not? Is it just the Yandex history? The geopolitical discount?
The report argues that yes, the geopolitical discount is the primary weight on the stock. Investors are wary. They look at the history and they price in a discount. They aren't giving it the AI premium that they give to other pure plays.
They treat it like an emerging market stock rather than a Silicon Valley growth stock.
Exactly. But the bull case argument is that this discount is temporary. It's a misunderstanding that will resolve itself. As they execute in 2026, as those U.S. clusters come online, the market will stop seeing them as the ex-Russian search engine and start seeing them as a premier AI cloud provider.
And when that perception shifts, the multiple expands.
And that brings us to the price targets. Wall Street consensus seems to be looking at a range of $150 to $160 per share.
Which, from the current level of around $85, implies an upside of roughly 80%. That is aggressive.
It is. But the logic is that you're essentially buying $1 of assets for 50 cents right now because the market is scared of the history. If the fear subsides, the price corrects upwards.
The technical setup mentioned in the report is interesting too. It says the stock is in an accumulation zone. What does that mean in plain English?
It means the stock is taking a breather. It's bouncing between $80 and $90. The report notes that $80 acts as a strong support level. Institutional investors seem to step in and buy whenever it gets that low. They're accumulating shares quietly.
Waiting for the breakout.
And the breakout level to watch is 110. A move above 110 typically triggers momentum buying. The algorithms kick in. If it crosses that threshold, the chart suggests a clear path back to the $140 highs.
So putting this all together, we have a company with a proven engineering team, a veteran unit. We have massive revenue growth, a partnership with NVIDIA.
Yeah.
And $2.5 billion in the bank to fund expansion without debt.
An evaluation that seems to ignore a lot of those strengths because of where the founders were born.
It does sound compelling, but I have to play devil's advocate here. What keeps the CEO up at night? What's the real risk?
The primary risk here is execution, pure and simple. Buying GPUs is easy if you have money. Building data centers, that's hard.
Hard how? Like construction delays?
Construction, yes, but also physics. You have to manage cooling for these chips. The new Blackwell chips run hotter than anything we've seen. You have to deal with energy regulations. You have to maintain 99.9% uptime.
And if they fail?
If a cluster goes down, that customer loses millions of dollars and weeks of work. They will leave and never come back. Reputation is everything.
So the risk isn't that they run out of money, it's that they trip over their own shoelaces trying to run too fast.
Precisely. But, and this brings us back to the start, the bull case argues this team has been operating hyperscale infrastructure for a decade. They aren't rookies.
That experience factor is the hidden asset. They've done this before, just under a different name.
And in a different jurisdiction, now they're playing on the global stage.
So, to summarize the bull case for our listener, you're essentially buying a venture-backed startup, but one with the bank account of a major corporation. It's a way to invest in the GPU shortage without buying the manufacturer and without the dilution you get from a giant like Microsoft.
That's a great way to put it. It's a pure play. If you believe the demand for compute is going to stay high, Nebius is one of the most direct ways to express that view.
And that 462% headline.
Yeah.
That was just the opening act.
It was the proof of concept. The real story is the deployment of that $2.5 billion war chest over the next 12 to 24 months.
It really creates a fascinating tension. You have this massive potential reward if the market reprices them, balanced against the operational challenge of scaling at breakneck speed.
And that brings us to a final thought I've been mulling over.
Let's hear it.
We talk a lot about the geopolitical discount as a negative thing. But if you're a value-oriented investor looking at the AI sector, a sector where everything is notoriously overpriced, you have to ask yourself a question. Is that geopolitical discount actually a warning sign? Or is it the biggest inefficiency left in the entire AI market? Because usually, by the time a company has $2.5 billion in cash and NVIDIA as a backer, the stock is already priced to perfection. Here, the market is giving you a chance to get in before the stigma fades.
That is a very provocative thought.
Mm-hmm.
Are we looking at a red flag or a golden ticket that everyone else is too afraid to pick up because of the label on the wrapper?
That's the question every investor needs to answer for themselves.
And on that note, we will leave you to ponder the future of the AI cloud. It's certainly going to be an interesting year for Nebius.
Absolutely. One we'll be watching closely.
Thanks for diving in with us. See you in the next deep dive.
Don't forget to like, share, and subscribe for more.